Hello, good day. Welcome to our dry bulks, commodities and freight webinar. I'm Ishan Bhanu, grains analyst at Kpler, and I'll be your moderator today. In this edition, we'll explore how increased grains production in the Americas affects the export program through the year, and how the resulting grains and dry bulk trade flows will impact freight markets around the world. We are joined by Matt Dara, who's our grains and oilseeds analyst based in England. And we also have Hanife Kamar, our senior dry bulks freight analyst based in Malaysia. The webinar will be recorded and the video and the presentation will be available to our subscribers on the Kpler platform. We love questions, so please feel free to send us your questions using the Q&A box, and we'll take them at the end of each section. So without further ado, I invite Matt to take the floor.
Thank you, Ishan. Yes, so we're going to be looking at the US corn and soybean crops. To begin with, on the first slide, we're going to start looking at how that US corn crop has been developing and what that means for production. So the chart, the screen grab on the left there is showing you how the US corn crop has been rated in good or excellent condition. And as we can see, since its inception, since May, we've seen a very strong rating with regards to the good or excellent conditions, way above what we saw the previous 4 years during that during the crop's development. And when we're looking at months which are more influential with regards to yield development, we're typically looking at what's happening in July, as the majority of the US corn crop is undergoing that silking stage. And as we can see during July, the conditions were relatively stable. We had the good to excellent ratio hovering between sort of 70 to 75%, 70 to 75%. So as a whole, that's kind of added a little bit more conviction and confidence behind the forecasts of record yield. And as we can see on the graph to the right, we can see where we've got yield at the moment. So that's where the USDA is currently at 188.8 bushels an acre. They moved it up from 181 bushels an acre in August. And that obviously is a record for the US corn crop, up from last year's record of 179.3 bushels an acre. So, and this is higher. We saw Pro Farmer did a crop tour last week, and they put the national average for the US corn crop at 182.7 bushels an acre. They're a little bit lower off the back of disease pressure that they saw during their scouting reports, but nonetheless still a record. And if we look at planted area, this would be they're at sort of the USDA at 97 million acres, just over 97 million acres, which would be the second highest planted area since 1936. And this planted area has been supported off the back of when we were back in sort of February, March time, that new crop soy corn ratio was very supportive of corn acres due to the pressure that we're seeing in the soybean market following the unsettled picture between US-China trade policy. And as a result, we've got a record production. So way above the previous record in 23, which was just above 15 billion bushels. We are seeing production above 16 billion bushels. And that's whether you take the USDA's 188.8 bushel an acre or Pro Farmer's 182.7, we're still seeing production at a record, at an all-time record. So if we look at how the export market's framing up for the US on the next slide, we can see that currently sales for the upcoming market year that will begin obviously in September are at a near record. So we're just below what we saw in 2021, and we're seeing quite strong demand from the likes of Mexico, South Korea, Japan, and also a number of other destinations which, although don't import an awful lot, when you aggregate this together, we're seeing improved demand in comparison to what we've seen in previous years. Of course, we are missing China from the US corn sales book at the moment, but this is not necessarily unusual for the corn market. The US corn US corn exports are a little bit more diversified with corn in comparison to soybeans. However, although we're seeing very strong sales at the moment, we do not forecast that US corn exports will outperform what we saw this year, this 24-25 marketing year. And this is off the back of the supply picture. The fundamentals are very different in 25-26 to what we saw in 24-25. And if we take a look at that on the next slide, please, Hannah. Thank you. We can see that for the US, we're expecting that sort of contraction in exports. So we're seeing it fall just below, sort of just above 60 million tons. So above the 5-year average, of course, but below what we saw last year. And this was off the back of improved supply from the likes of Brazil, Argentina, Ukraine, and Russia. So in Brazil, we've got exports rising just above for the 24-25, around sort of 44 million tons. And we're expecting this this sort of these exports to come a little bit more online later into the later into 2025. Currently, Brazil is focusing quite a lot of their exports on soybeans at the moment, which is pushing Brazilian corn exports later into the year. So it'll have more of an impactful, it'll have greater impact on US corn exports as that supply becomes online, and we'll see greater competition between the US and Brazil at the beginning of the 25-26 marketing year. Of course, we're not expecting to see Brazilian exports as strong in 25-26, and this is off the back of increased domestic consumption of corn, mostly due to an increased usage of corn for ethanol production in Brazil. For Argentina, we're expecting to see quite robust exports in 25-26, which will continue to compete against US US demand as well. And also, we're expecting to see improved production in the likes of Ukraine and Russia later this year. Although we had quite a dry period around sort of May, June, we have seen improved rains in July and into August now, which has helped to improve the outlook with regards to corn production in Ukraine and Russia. And as a result, we're expecting to see them to be a little bit more prevalent on the export market in 25-26, which will further challenge US corn demand in the likes of Middle East and North Africa. And as a result, we're expecting to see US corn ending stocks rise quite notably in 25-26, up to around sort of 2.4 billion bushels. So quite a bearish outlook at the moment for the US corn market. And if we take a look at what that means for calendar spreads in the CBOT corn market on the next slide, we've been sort of paying quite close attention to how the September and December calendar spread has been performing on the CBOT corn contracts. And we've seen as a percentage of full calorie has been on the rise following this kind of bearish outlook. Seeing a lot of selling pressure on the sort of the front month there. And we're expecting a similar trend to occur for the spread between the December and the March corn contract. So at the minute, we're about 60% full carry. We're expecting this full carry to increase and see a similar trend to what we saw between the September and the December corn contracts. Because as we near expiration for the September corn contracts, we're going to see a lot of funds roll those short positions into the next front month, which will then become the December corn contract. And as a result, we're expecting to see that carry in the market widen between the December and the March corn contract. So yeah, just sort of one calendar spread that we're paying close attention to at the moment. So if we turn to what's happening in the soybean market at the moment on the next slide, we should hopefully see, thank you, Hanife. We should hopefully see a similar trend with regards to the corn crop. So currently, good to excellent conditions for soybean crop. Perhaps not as consistent as what we saw for the corn crop, but we are seeing ratings above what we saw in 21, 22, 23, falling somewhat in line with what we saw last year. While for the corn crop, we tend to focus more on weather in July with regards to how the yield's shaping up. For the soybean crop, we tend to pay more attention to what's happening in August when we have that soybean crop setting pods, which is a key yield determining stage. And as we can see, the condition of the crop was relatively stable during August, which has helped to add, similar to corn, also helped to add to that confidence with regard to a record US soybean crop with regards to yield, of course. And as we can see, the USDA have yield at around 53.6 bushels an acre. This is, of course, a record. It's above the previous record, which was in 2016. That was 51.7 bushels an acre. And if we look at how in the Pro Farmer Crop Tour last week, they had the national yield at 53.0 bushels an acre, so just shy of where the USDA are at. This is off the back of, yes, disease pressure. We're also seeing a little bit of pest pressure as well, Japanese beetle, impacting yields, and also quite a lot of dryness in the eastern area of the Midwest too, which is leading to a little bit of concerns with regards to how that soybean crop is going to finish up. But nonetheless, still a record yield. However, we did see that big cut on the soybean acreage. So we're seeing it around sort of 80 million acres, the second lowest since 2013. And as a result, we're expecting to see, and this has come off the back of those lower soybean prices. So obviously, US soybean growers are planting soybeans around sort of March, April time. And during that period, we saw a very unsettled picture with regards to how US-China trade policy was shaping up. US growers obviously very aware of how low those soybean prices were during the first trade war between the US and China in 2018-19, which led to a significant cutback with regards to the planting of soybean acres. So as a result, we see sort of that high yield compensating for the low area and seeing production fall in line with the 5-year average between 2020 and 2024. So yeah, if we move on to the next slide to take a look at the export picture, it's been widely documented that China has been absent from the US soybean market. The chart on the left there is showing US soybean sales for the upcoming marketing year. As we can see, China is absent from that. This is, in fact, the first year, although I appreciate it might be a little bit challenging to see on the chart there, but this is the first year across that time series where we don't have any US soybean sales to China on the books for the upcoming marketing year. And although we have seen stronger demand from the likes of Taiwan, Pakistan, Mexico, and other sort of destinations, the improved demand from these countries is not able to offset the lack of Chinese demand. China typically accounts for about 60% of US soybean exports, and the US is struggling to find the equivalent strength of demand from other sort of soybean importers. Those exports, those US soybean exports to China are typically concentrated in October, November, December, when that sort of Brazilian soybean crop becomes, or the supply of Brazilian soybeans becomes near exhaustion, and the supply of US soybeans becomes online. But as we can see here on the chart on the right, we're not, under current trade policy, we are not forecasting any US soybean exports to China. Currently, the American Soybean Association says that US soybeans are pricing 20% more expensive than South American supply. So although on a FOB market, you can see US soybeans are pricing lower than the likes of Argentina and Brazil, once you add on the tariff, or once you add on China's import tariff, suddenly US soybean exports become far less competitive with regards to what Brazil and Argentina can offer. So as a result, we're seeing that sort of continued demand of South American supply from China, and that window will narrow for the US to sell soybeans to China. We have the current trade agreement that is due to expire in November, and if we don't see any sort of change with regards to that trade policy, it's going to be very difficult for the US to export any soybeans to China. Of course, China is recently, I believe later this week, are going to send one of their trade delegates to the US to discuss trade policy between the two nations. And whether this leads to any sort of change in policy is definitely a key watch point going forwards. But as it stands, we aren't seeing the US being very competitive with regard to Chinese demand. And also, if the price is right, Brazilian soybeans, can come online as early as January. So that window is very narrow for US soybeans to export to China at the moment. And if we take a look at the next slide, we'll look at sort of the fundamentals a bit more clearly, hopefully. As we can see, we've got the US soybean exports contracting on the year into 2025, and we're expecting stronger exports from the likes of Brazil in 2025, way above that previous 5-year average, and above what we're currently seeing in 24-25. Also, of course, appreciate it's a bit of a relatively speaking, we are seeing the scale between Argentina and Brazil is a bit different, but we are seeing stronger exports from Argentina following President Milei's relaxation, lowering the export tax of soybeans has helped to encourage soybean exports from Argentina. Of course, they're sat on quite large ending stocks at the moment. So again, if we're seeing this strong import demand from Argentina, this strong import demand from China, for South American supply, this is helping to release a lot of those ending stocks a lot of those stocks from Argentina, which has been sort of encouraged from the drop in that export tax from President Milei. And as a result, we're seeing the US soybean ending stocks rise up to near 540 million bushels, sort of in line to what we saw in the previous trade war in 2018 and 2019. And if we want to just take a look on the next slide with regards to where we see Brazilian soybean planting for the 26 crop, we can see that for the CBOT March soy corn ratio, which is something that some Brazilian growers may use to determine their interest in sort of acreage expansion or the planting of soybeans in Brazil. We can see that it's risen above 2.5. Anywhere when that ratio sort of reaches north of 2.5, that's kind of is an indication that there's going to encourage soybean planting, where the ratio is favouring more soybeans than corn. And we can see there was that slight uptick around the sort of the 10th, 11th of August. This was in light of Donald Trump's tweet, where he urged China to quadruple their sales of, urged China to quadruple their purchases of US soybeans. Of course, just for clarity, there are 0 soybean sales to China at the moment, but the sentiment behind this message drove a lot of optimism in the market that we were going to see increased soybean sales, increased US soybean sales to China, which drove the price of soybeans on the CBOT market. So that kind of lifted the CBOT March soy-corn ratio above 2.5. So it's going to be a factor. It's not the only factor, but it's going to be a contributing factor towards acreage expansion in Brazil, which we currently see at 2%. So it's not the 2%. It's not the 10% acreage expansion that we saw in 2025, but it's still a small rise, and it would be the 18th consecutive year of Brazilian soybean expansion. Following sort of improved demand, of course, from China, with regards to how Brazil's been acquiring more of that market share of Chinese demand. But we have seen that the variable cost of production tighten in Brazil. This year, in Mato Grosso, the largest soybean producing state, we see the variable cost of production increasing 6% off the back of increased fertilizer costs, pesticide costs, and labor costs. Whereas in 2025, the variable cost of production only rose 1%. So it was a little bit more. So the increase in variable cost of production for 2026 is discouraging that acreage expansion at the moment. Of course, yield, we'll get a better understanding with regards to what yield will look like in the coming months. The soybean sowing campaign in Brazil is due to begin in September. So once we've got an understanding of how early or how late that crop was planted, will help to give us a bit of an idea as to where yield could shape for 2026. And then that summarizes, that concludes my own soybeans. Happy to take any questions if we've got any that came through, Ishan.
Thank you very much, Matt. There are a few questions. Let me start with the one on soybeans. I appreciate you have answered part of this, but the question states, crushing margins for both US and Brazilian soybeans are deeply in the red. Do you expect continued imports by China from Brazil in Q4 and less imports from the US?
In short, I would say yes. I think we are expecting to see continued import demand from Brazil off the back of the current policy. If current policy stays as it is, we are expecting to see continued interest for soybeans, as we're expecting to see further stockpiling of soybeans in China. So although yes, we are seeing that pressure on crush margins at the moment, we would still expect to see continued demand from China with regards to South American soybean supply, and an absence of interest with regards to US import demand, US exports.
Thank you, Matt. On corn, your US corn exports for 25-26 is quite a lot lower compared to USDA. Main reasons for that?
Yeah, so of course, so main reasons for that is the strength in exports from the likes of Brazil, Brazil, Ukraine, and Russia. So we're expecting to see Brazilian corn supply become more readily available later in this calendar year, which is going to closely compete with the beginning of the US corn crop in sort of 25-26. So as a result, that's going to, although we've seen very strong sales at the moment with regards to the US corn crop, as we sort of near the end of 2025, we're going to have a greater availability of Brazilian corn supply, which is going to closely compete against the US. And also, come sort of October time, we're going to see the Ukrainian and Russian corn crop come online as well, which is further going to pressure the competitiveness of American supply. So we're seeing the 25-26 supply of corn to be a lot more well supplied. In 24-25, we saw the US dominate corn exports because of a lack of supply from the likes of Brazil, Ukraine, or from the likes of and Russia as well. Sorry, Whereas in 25-26, we're seeing much stronger production in Brazil and Ukraine. And we think this better supply, a better well-supplied market gives those key importers a more diverse supply of corn, which will challenge US exports in 25-26.
There's one more on soybeans. Won't Brazil have run out? Won't Brazil run out of soybeans to export in Q4 beyond draining some inventories?
Yes, so Brazil are definitely near exhaustion of their soybean exports, but it's worth mentioning that for the Argentine crop, I mean we're still in the midst of exporting a record Brazilian soybean crop near Q4, and as we're seeing recently, I mean recent sort of trade flows data on the Kpler terminal is showing that although we're seeing a gradual reduction in Brazilian soybean exports, we are seeing an increase in exports from the likes of Argentina, which has been sat on quite heavy ending stocks for the recent few years off the back of what many Argentine soybean growers use as an inflation hedge. And as we're seeing more recently off the back of the lowering of the export tax from President Milei, the increased exports from Argentina is helping to offset the lesser Brazilian soybean exports. So yes, we are expecting to see Brazilian soybean exports gradually decline as we near the end of 2025. We have still got very ample supply of soybeans in Argentina, which China could tap into as the current tariff on US soybean exports is about 34.07%. So it has really lifted the lid on how high Brazilian and Argentine soybeans can price. So this is giving, that kind of South American supply a much more better advantage of getting that Chinese supply. So yes, Brazilian soybean exports will fall, but we're expecting Argentina to perhaps make up for any loss of exports or improve supply.
Thank you, Matt. And if I may add, our estimates on exports for the next 12 to 18 months are shared in our balance sheets. So we do see Brazilian exports going down, but there is an assumption that China will, despite reduced imports, China will wait for the next Brazilian crop rather than take US soybeans with duties. It's very different from the first trade war, where this year China is better able to avoid US soybeans. There's a more general question on the balance sheets. What effect will high stocks have on US corn and soybean exports in the subsequent market year? Do we expect the US to be able to ship out these stocks at a later date?
I think it's difficult to see. I think trade policy remains to be in question. I mean, if we see any sort of improvement with regard to trade policy between the US and China, we could really start to see a tightening with regards or a lowering of the ending stocks of US corn and soybeans, which could help to improve the outlook for 27, 28, that would, or 26, 27, sorry. So I guess trade policy would be a key watch point with regards to how those ending stocks could look. But I think, it is a difficult one to see. I'm not too sure with regards to how things may look towards the latter half of 26. I think it's a watch point with regards to how trade policy unfolds. And also, we are on El Nino watch. Brazil obviously is the second largest producer of corn. If we start to see any pressure with regards to corn production in Brazil in 26, this could really help to improve the outlook with regards to the US corn export program towards the latter half of the 25-26 marketing year, which will really help to improve their sort of the competitiveness of US corn in the market, which could help to tighten that kind of ending stocks for corn. I'm not too sure if you've got any further comments on that issue too.
Yeah, absolutely. Agree with you. Trade policy will dictate what happens in the next few months. And our balance sheets indicate that overall, the corn and soybean production are, if you include all the major exporters, corn and soybean production is higher than global consumption, unless there are supply side weather related issues. Unless there are supply shocks, We have seen corn and soybean production increase over the years. At this point, that increase is faster than the increase in consumption. And hopefully, the next question can help on that. How can favorable US biomass-based diesel policy support domestic consumption for US soybeans?
Yeah, of course. So we have seen it was a long wait, but the EPA, once they released their outlook with regards to biomass-based diesel demand for 26, 27, it was very supportive of domestic soybean crush in the US. But it's worth bearing in mind the bottleneck with regards to soybean crush in the US is due to capacity. It takes a long time to build soybean crush plants in the US. Even if we've pushed domestic soybean crush up 100 to 200 million bushels off the back of this improved policy or more favorable policy, it's still not enough to offset Chinese import demand for US soybeans, which historically has been around 800 to 1200 million bushels. So we're still at a deficit there with regards to offsetting the Chinese demand. And it's worth bearing in mind that the ending stocks figure that we showed in the previous slide with regards to US soybean ending stocks, that had factored in quite ambitious US soybean crush, but we're still seeing quite heavy ending stocks. So yes, it's favorable, but it's not yet enough. The US is still very reliant on a good soybean export campaign to lead to tighter soybean ending stocks.
Thank you, Matt. And there's a question on wheat. Do you have a view on Russian wheat exports? Are you expecting volumes to recover?
Yes. We've been paying quite close attention to this, and we have been seeing that in our lineups for September, we've seen a notable improvement. Of course, we did have that delay. It's difficult to make a year-on-year comparison because last year we saw quite dry and warm conditions, which accelerated the maturity of the crop, which is why we saw very strong exports earlier, well, around sort of June in 2024. So it's year on year, it's very different, but the conditions are a little bit different. But we are expecting exports from the likes of Russia to improve in the coming months. And what this will do is it will, because of course, that harvest pressure has just been delayed, it's not been cancelled. So we are expecting to see exports rise in September and a kind of almost like a backlog of wheat supply, which is now nearing the ports, nearing those sort of Black Sea ports. So Russia will become more dominant. Of course, at a FOB basis, we've got Western European origin, Western and US origin are pricing more competitively than Russian grain. But we don't believe this will last. We expect to see the Russian grain to become Russian wheat to become far more competitive in the coming months as stocks at ports begin to rise, as stocks at ports begin to rise, we expect to see Russian exports become far more competitive in Q4.
Thank you very much, Matt. If you have more questions, feel free to keep sending it in the Q&A box, and we'll move on to the next section of our presentation with Hanife.
Thank you, Ishan. So I'll speak about why freight market matters to seaborne grain and coal trades. So freight market moves in cycles, and this will have a different impact on both sides of the table. For example, firstly, it's about anticipating when freight rates are going to run high, so you can plan your cargo booking, to avoid high shipping costs. Secondly, it's about recognizing when demand is weaker, so vessels can plan for repositioning to region with stronger demand, or even send ships for dry docking to maximize the benefit of downtime from lower demand. So these two are the lens that I like to use by looking at how grain and coal trades are shaping the demand for dry bulk carrier and what this means for September and the fourth quarter. So let's take a look at where Panamax earnings stand and how voyage rates are being shaped. So chart on the left, this is the Panamax time charter average split into years. So what has happened in 2025 so far? So Panamax earnings had underperformed for most part of the year. So for example, for the past 7 months, the average daily earnings was just under $11,500 per day. So when we compare with the same period last year, that is 28% lower than the $16,000 per day. This trend has changed from June onward, so it has risen upward. And by July, earnings have firmed to just under $16,000 per day, slightly above 2024 level. And the main driver for this is obviously outstanding Brazilian soybean exports, and we had seen seasonal coal imports in the Pacific. My expectation for September is I'm expecting support to the Panamax time charter rates to be driven by Brazilian corn exports, which are underway. And it will also be followed by another seasonal coal imports in the Pacific. However, in the fourth quarter, demand will be very weak because by this time, South American grain exports, especially from Brazil, would have gradually declined. Plus the downturn that we are expecting from US soybean exports based on the current policy between US and China. Chart on the right is the grain spot freight rates for shipments coming out of US Gulf and also Brazil. So compared to time charter rates, spot freight rates, they don't only reflect the supply and demand of vessels, but also bunker prices as well as other ancillary costs for running ship. So the annual decline in bunker prices for most part of this year have weighed on spot voyage rates. These are dollar per ton. For example, the spot voyage rates from Brazil to China at this point, last year in August was as high as $45 to $46 per ton. But this year, August this year, they've just been around $40 per ton. And I expect this trend to continue because of declining bunker prices. Declining bunker prices will weigh on spot freight rates in the short term and also the medium term. Our crude oil analysts are forecasting the very low sulfur fuel oil in the Singapore market to trend between $430 to $500 per ton for the next 12 months. So a key part of this story is Brazil. Now let's take a look at our projection for Brazilian soybean and corn exports. So chart on the left is the projected Brazilian soybean and corn exports. So Brazilian grain chartering have been driving the demand for Panamax and Supramax, and also some Hanife, which is your smaller segment. But corn exports will be the next driver throughout the third quarter. But because we've seen a delay to harvest, we will see some of this trend being spilled into early October. Soybean exports are in seasonal decline, but they have been outperforming last year's level. And we expect the same strength for Brazilian corn export as well, for reasons that my colleague Matt have mentioned just now. However, let's remind ourselves that 2024 was not a stronger export volume coming out of Brazil, but 2023 was the stronger one. So although we are saying that grains loading at Brazilian ports have been higher this year compared to last year, a better comparison is better if we compare it with 2023, when export volume was stronger. This is important to remember because this gives us a clearer indicator to congestion at Brazilian ports, which you can see from chart on the right. So chart on the right is the congestion level of vessels waiting outside the port to load Brazilian grains. And this is in terms of vessel count. So for the past 7 months, congestion has been on average 4% above 2024. But for the month to date in August, this has jumped to 13%. However, it's still below 2023 when export volume was higher. And this is simply one of the reasons is better investment for the port infrastructure. So the key takeaway here is strong demand for cargo lifting is usually associated with vessel congestion at ports, which can tie up vessel supply and push earnings or spot voyage rates higher. But this has not been the case so far this year. But it's a good one to watch. Now let's compare demand in the Atlantic Basin and also the Pacific Basin, because this will also give us an indicator of vessel positioning. So chart on the right is the Panamax earnings for vessels that are trading in the Atlantic Basin and also the Pacific Basin. Atlantic earnings have been benefiting from stronger US corn exports this year. And so this is supporting demand in the North Atlantic. And right now, US wheat exports are also building seasonal strength. And in historical terms, they are the strongest in the month of September. So meaning to say Atlantic earnings will be firm at least until September. However, I'm expecting lower demand in the North Atlantic in the fourth quarter as a result of the downturn in US soybean exports, which we have discussed just now. So as a result, the Panamax Atlantic round voyage earnings, which you can see in dark blue, they will decline sharply in the fourth quarter. In the Pacific, demand will rise higher because of seasonal coal imports in the Pacific Basin, which will be driven by China. So rates on the Pacific round voyage will rise firmer. Lower Atlantic rates, but higher Pacific rates means that Pacific Basin has more concentrated demand compared to the Atlantic Basin. So there will be less incentives for vessels to reposition out of the basin. So I'm discussing this because it will give a good indicator to the end of the grains export season from South America, which I will discuss in the next slides. But before that, let's take a look at chart on the right. This is your time charter earnings for Supramax vessels and also the Pacific coal routes, which is the voyage from Indonesia to India and also Indonesia to China. Seasonal coal imports do not only support the Panamax vessel, it also gives support to the Supramax vessel, your smaller vessels, but there's a limited upside to how this can support demand for dry bulk carrier. We can see this if we compare the rates between voyages to India and also voyages to China. In past, these routes have tracked each other quite closely, but since April, they have diverged quite largely. For example, the difference between these voyage rates were only 3% in the past 7 months last year. But for the past 7 months this year, that percentage has grown to 19%. So meaning to say, voyage to India has been priced at a larger discount compared to, voyage to China has been priced at a larger discount compared to China. Why so? So the elephant in the room is the structural decline in demand for seaborne coal imports, which you can see from chart on the left. So chart on the left is our projection for seaborne thermal coal import driven by India and China. So demand has been increasing gradually since June, and we will see further strength for the remaining of the year. But on the larger picture, we are projecting volumes to be lower compared to the past 2 years. And this is down to the effort that China and India has been doing to build greater supply of its domestic coal. So they do not need as much as imported coal. So in the fourth quarter, although more demand will be concentrated in the Pacific because of coal trade, it will not be as strong as the previous years because of the structural decline. And by this time, by fourth quarter, we will see a gradual decline in South American grain exports. And like Matt said, China accounted for 60% of US soybean imports. So a gradual decline in South American grain exports, in which China is also the major buyer. You will see a lot of shipments discharging at Chinese ports. So that will add to vessel supply coming online in the Pacific Basin. And that's what you can see from chart on the right. So chart on the right shows the level of laden and ballast vessels for Panamax in the Pacific Basin. Panamax supply in the Pacific Basin has been increasing at a higher rate compared to last year. by August, it rose 6% year on year. So this means there will be more ballast supply competing for the demand in the Pacific, especially the coal trades, which will further put downward pressure on time charter earnings and also spot voyage rates. Now, coming back to grains, it's another Black Sea wheat exports is another important driver for geared vessel segments. Chart on the left is our projection for wheat exports from Russia and Ukraine. These are building seasonal strength. So this will be the major driver for the smaller vessel segments, such as your Handysize and also your Supramax. However, shipping costs, the cost to ship Black Sea wheat cargoes have been seeing some additional costs. For example, the Mediterranean Sea is now an emission control area. So any ships that are carrying grains out of the Black Sea passing through the Mediterranean Sea will need to burn fuel with even lower sulfur content at maximum 0.1%. Secondly, Turkey has been increasing its transit fee at Dardanelles and Bosporus Straits. And also, there's a higher risk to pay demurrage because Russia has increased its security for loadings at Kafkas ports. So now for port calls at Kafkas port, on top of the port authority clearance, a vessel needs approval from their national security service before entering that area. So when we look at Black Sea wheat shipments, it's also important to monitor the transit level at Suez Canal because most demand for Black Sea wheat is concentrated at North Africa and also the Middle East. Let's look at chart on the right. This is the dry bulk trade at Suez and Panama Canal as a percentage of global trade. Transits at the Suez Canal have been declining because of Red Sea crisis. So vessels are avoiding risks, and also because of higher insurance premium that has added costs to vessels that are navigating around that area. We do not expect any normalization in transit for the short and medium term. And a lot of shipments, apart from Russian grain shipments, are still taking the longer route via the Cape of Good Hope, meaning they need to pay additional costs for their shipments. With regards to the downturn that we are expecting for US soybeans in the fourth quarter, what that will happen to transit level at the Panama Canal is we are expecting lower transit at the Panama Canal in the fourth quarter. So far we've talked about demand. Let's take a look at vessel supply. This gives us a medium and longer term outlook to vessel earnings and also spot voyage rates. So over the medium term, lower fleet growth and supply constraint on existing dry bulk vessels will provide a floor on dry bulk demand. What I mean is, let's take a look on the left chart. So left chart, this is your projected dry bulk carrier fleet growth of any dry bulk carrier that's 10,000 deadweight ton and above. For the past 3 years to 2024, fleet growth has been modest. It's just at under 3%. But in 2025, we are expecting a lower rate of fleet growth compared to 2025. And this is because one of the reasons contributing to this lower fleet growth is because of tighter yard capacity, which means that vessels that were supposed to be delivered this year are being pushed to be delivered next year, which is why you can see that in 2026, annual fleet growth will return higher compared to last year and the past 3 years. So takeaway from chart on the left is although there are some structural decline in dry bulk trades, tighter supply of fleet because of lower vessel delivery, and also some supply constraint that I'm going to talk about chart on the right will give a floor to time charter earnings and also spot voyage rates. Another challenge that is testing the supply of dry bulk carrier comes from the proportion of dry bulk vessels that need to enter dry docking for scheduled maintenance, which you can see from chart on the right. Chart on the right is the proportion of dry bulk carrier, 10,000 deadweight and above, that needs to enter dry docking to comply for their special survey requirement. At least 15% of dry bulk carriers starting 2025, at least 15% of this capacity by vessel count will be removed from the market as they enter the yards. So what this means is that more and more ships from this year until 2027 will be taken out of service for longer. And because we are seeing a higher rate of vessels entering dry dock in 2026, this could also create congestion at the yard. So again, when there is higher congestion at the yards, it will exaggerate the impact of fleet being taken out of the service for special survey and tie up supply. So as a conclusion, what this means to time charter earnings and also spot voyage rates, in the third quarter, the big driver, at least until the next one, which is the concluding of third quarter, the big driver will still be South American grains. That will keep dry bulk vessels demand firm, but will be softer in the fourth quarter, in which the rates will decline sharply. Like we have discussed just now, we are not expecting an upturn in US soybean exports, so demand in the Atlantic will be very weak. Secondly, South America, they have been providing a lot of shipments today, but because most of this buyer is concentrated in China, by the end of the export season, voyages that are discharging shipments in Chinese port will add to a surge in vessel ballast supply in the Pacific. The impact that has on firmer coal trade is that there will be more vessels competing for coal shipments. So number one, we are already seeing a structural decline in coal imports that will push down freight rates. But because there is also more vessels competing for this shipment, we will see a steeper decline in rates. And thirdly, Black Sea wheat exports are building seasonal strength, but shippers that are shipping Black Sea wheat shipments are seeing additional costs. And finally, over the medium term, dry bulk fleet development gives us an indicator of medium-term dry bulk demand. Fleet growth will slow down in 2025, and supply constraints by vessels entering dry dock for special surveys will put more pressure on fleet supply. Yep, thank you. Happy to take questions.
Thank you very much, Hanife. There are a few questions, so let's start with the first one. As an owner, would it be better for me to trade my Panamax spot through 4Q25 to first quarter 26, or take a 12-month period charter starting now?
Yeah, that is a good question. So I think the main driver that we need to consider is the coal trade, which we are projecting in 2026. So obviously, this will see a structural decline. But at the same time, we are seeing an even better supply coming out of South America. So I think these are the two factors that one needs to consider when considering about one's trading decision.
Great, thank you. The next question is, how will the difference between Atlantic and Pacific time charter rates affect vessel positioning?
Okay. So Atlantic earnings, this is as an indicator, is a large reflection of demand in the North Atlantic basin, while earnings on the Pacific reflect demand in the Pacific Basin. So usually, I mean, in historical terms, you see that Atlantic earnings are priced at a premium to the Pacific. But this is not always a reflection of a stronger demand in the Atlantic Basin. This could also be affected by tighter supply as opposed to surge in demand. So for example, when the Atlantic earnings are priced at a significant premium to the Pacific round voyage rates, some owners may interpret this as a stronger demand over there. And if they believe that demand will stay strong over the medium term, some owners might reposition and commit to these longer voyages than staying in the Pacific Basin where demand is softer.
Great. So is the takeaway from your presentation is that Q4 Panamax and Capes are bearish from current levels?
Q4 Panamax and Capes. I'm not sure I spoke about Capes just now, but can you repeat that question again? I didn't think I spoke about Capes.
Is this takeaway correct? Q4 Panamax and Capes bearish from current levels?
All right. So now we are introducing a new concept, which is a relationship between Capesize and also Panamax. So yes, I'm bearish on the Panamax in the Q4, but when we are considering the strength in Capesize, this gives us a different idea. So what had happened in the past is, for the past 7 months, when time charter earnings for Capesize compared to the Panamax time charter earnings, when we quantify this in terms of ratio, when this ratio rises above 1.21, which is their long-term average, you will see a trickle-down effect to the Panamax segment, in which when the Capesize vessels becomes too expensive for same shipments that Panamax are carrying, you will see that this demand, for example, the stem of cool Capesize shipment being split into the Panamax. So I don't think there's a definite answer to it, but if we look at Panamax in isolation, which we cannot do, I'm bearish in the fourth quarter. But if we look at the bigger picture, a strength in Capesize market can provide a floor and induce demand to the small segments.
Great answer. Thank you, Hanif. There is another question which I think applies to both our speakers. Maybe Matt can start and then Hanif can follow on this. The question is, can you shed more light as to why you expect Russia-Ukraine shipments to be at a 2-year high?
Yeah, sure. I have to look at sort of the fundamental side of this with the grain space. Within Ukraine and Russia, of course, we have an absence of a forward market, which tends to typically encourage spot demand for exports. So that is one factor. A lot of growers, typically because they don't have much foresight regards to where prices may be in the upcoming months, they tend to take demand at the spot market. Also, if we look at how harvest had rolled out for both Ukraine and Russia, when we look at the Russian production, typically we see quite strong production in the southern area, which is obviously close proximity to where the Black Sea ports are. However, we saw quite poor production in the southern region due to dry conditions, which meant that although we had obviously this production was being brought to ports, it wasn't quite in an ample supply as previous years. And then we had harvest pressure, we had delayed harvest in the central and northern regions of Russia due to quite consistent rainfall, which delayed this kind of supply reaching the Black Sea ports. So we've kind of got a delayed or somewhat of a lag of exports from Russia following that delayed harvest progression. Production has been quite good, well, relatively good in compared to what's happening in the south, in northern and central regions. It's just the delay of transporting it from those regions to Black Sea ports is leading to a greater concentration of exports in Q4. We're also seeing quite latent demand, which is evidenced sort of by those higher prices. North Africa obviously is turning their eyes more towards what we're seeing, or turning their eyes towards what demand sort of Western European origins as well, due to sort of that price competitiveness. But we do expect to see an improvement in Middle East and North African demand later into the year, which as that kind of Black Sea grain becomes more widely available. And also, of course, Hanife's chart was showing seaborne exports, which doesn't obviously include overland exports. And recently, trade policy between the EU and Ukraine has changed in June. It's where they've gone, or the autonomous trade measures that they had, which resulted in duty-free imports of Ukrainian wheat, is no longer the case. Up until June, until the end of the current calendar year, the Ukraine are able to export 600,000 tons of wheat to the EU duty-free. And then once it surpasses 600,000 tons, it's around 600,000 tons, it then gets hit with a €95 ton import duty, which immediately prices out of competition. So we're expecting to see a greater greater volume of wheat exports via the Black Sea from Ukraine, following that change in policy between Ukraine and EU. That trade policy is still under discussion. They're still working out the new the DCFTA trade policy between Ukraine and EU, which will set up the new trade import limits. But as it stands, this is kind of a stopgap at the moment of 600,000 tons with that duty. I don't know if you had any further comments on that, Ishan. Sorry.
No. Thank you for the answer. I think talking to traders of Black Sea grain, we have seen them struggle with freight a lot. So a lot of it, the wheat's ability to get the correct freight out of the Black Sea with higher inspections costs in the Black Sea, as well as higher cost due to the Red Sea crisis, that will kind of dictate how much of the grain gets pushed out. But in terms of the availability of buyers and sellers, we see we should see very high volumes. Let's go to the next question for Hanife. Historically, second half of the year has been considered the strongest for dry bulk earnings. Would you say that the changes in grain fundamentals, more US corn and Brazil soybean, could lead to a change in earnings seasonality, that is stronger earnings in first half, worse in second half?
Yep. So I think we need to consider at least two things. Number one is the export volume, and also the voyage distance, right? So if there is a prolonged downturn in US soybean exports, obviously the voyage from US to China is slightly farther than Brazil to China. The second thing we can consider is the passage that they are using. So for example, for US soybean exports, a huge portion of these are coming from the US Gulf. So naturally, their route that we'll be using is the Panama Canal. To add to this complexity, so remember, your grain carrying vessels are mostly your Kamsarmax and also your Ultramax. Not both of these are using the Panama Canal. Some of this is taking the longer route via the Cape of Good Hope, and some of this is still transiting the Panama Canal. So I don't have a definite answer as if this can really change the seasonality of Panamax earning first half and second half. But we need to consider, as opposed to, in addition to export volume, we need to also consider the routes that they are taking, which are going to affect the time taken for the voyage to complete. Sorry, Ishan, I think you're on mute.
Sorry about that. Thank you very much, Hanif. I appreciate there are more questions, but please send us an email and we'll be very happy to answer the questions. Usually, if they're not anonymous, we answer them after the webinar anyways. And if we go to the next slide, I just want to say that if you're not subscribed to Kpler and would like to try our dry bulks insight, please reach out for a trial by answering the question that pops up after the webinar has ended. Thank you again very much for joining, and feel free to reach out to us on email.